what do you consider to be the top mistakes that home buyers make when they apply for a mortgage and when they're in the process of buying a house?
Yeah, that's a great question. I think in this environment, probably the biggest mistake that people are making is not understanding where the affordability is. They're going into a tennis shoe store to buy shoes and they see those Air Jordans that they really love. But when you take into consideration the values of homes that have gone up, higher interest rates that we're experiencing right now, they really should be buying the Converse, the Larry Bird Converse instead of the Air Jordans.
Yeah.
So that's probably, and that really starts, on the side of actually, you taking them out and showing them what's out there. As the actual application goes, I think some of the things that people misunderstand or maybe make a mistake as it relates to the application is going to be their income. I think particularly self-employed people typically think that they make more money from a qualifying perspective than they really do, because we qualify a self-employed person based on their taxable income, not their gross income. So that's a mistake that people make. Any kind of variation to income that's not a fixed guaranteed amount of pay can be treated differently than what the buyer expects it to be. So I'd say that's a big one. Credit is probably the number one, I would say, because people will call me and say, oh yeah, my credit score is in the high 700, should be 780, 785, and I pull it and it's 690. And you're like, where was that disconnect? And I think part of that comes from having, checking your credit with like Credit Karma. No knocking this time. I think Credit Karma offers a great service because it can tell you if there's any huge swings, maybe something that needs to be addressed that you wouldn't have otherwise. But I also think that, because Credit Karma pulls a one bureau pull, it doesn't have near the data, near the updated information that a mortgage credit report is going to have. It often gives the buyer a sense of a better score than what's real. So I think that to me is the other one. I mentioned assets. I'm really kind of hitting on the main topics of the things that we look at. But cash to close is another one because, somebody may think, okay, by the time I get to closing, I'll have a couple more paychecks come in and I'll have enough money to close. That may or may not happen. And even if it does, it becomes a little bit more of a difficulty with documenting proof that that's all happened. So those are the main things that I see just in general terms as it relates to, kind of mistakes, or at least not necessarily mistakes, but maybe just seeing
what people overlook.
An overlook or thinking is different than what it will actually be.
Awesome. All right. Now, this is a secret, a highly kept secret that is locked that we want to unlock. What are the ways in which a buyer can quickly pay up their mortgage? What can they take advantage of in order to pay off their loan quickly?
Discipline with their budget.
Discipline with their budget.
The funny thing with finance in general is there is no secret magic pill that you can take and all of a sudden you
break my heart right there.
Just go in order.
You're breaking my heart.
It's like the several of the things that we do now to help lower a payment, which are things like permanently buying the interest rate down, doing a temporary buy down, like a 2-1 buy down, where if rates are now at 8%, a 2-1 buy down will allow you to have a 6% rate in year one, 7% rate in year two, before it goes to 8% and let somebody ease into that payment limit. So those are some things that help with payment, help with affordability. But now, as far as just paying your loan off and what do you do to make that happen more quickly, honestly, it really does come down to budgeting, because to pay a loan off faster means you got to pay more.
Pay more. That's it.
If my payment's $2,000 a month and I want to pay it off faster, I got to pay more than $2,000 a month. Whether that's an extra $500 a month, whether it's $1,000 a quarter, whether I just drop $10,000 once a year. Any of those type things, that will pay my loan off faster, but they all require discipline to not spend the money, save the money, apply it to the loan.
Okay, good. So I've heard about this. If you're just making 1 month extra payments each year, that you can knock off a 30-year loan term from 30 years to about 25 or thereabout. What do you think?
Somewhere in that 23 to 25, depending on what the interest rates are. And that's a great idea. And we're actually now having this conversation that we probably wouldn't have been having 2 years ago. Because if someone had a 3.5% mortgage, as an example, which is what the rates were 2 years ago, I'm more of the opinion, don't pay anything extra on that. Now, once you've paid off everything else that you may owe, student loans, car loans, credit cards, it's all paid off. You've gotten the money into your emergency fund so that you've got future help in case problems arise.
Yeah.
You've saved up money for your retirement. You've started putting money in for college kids, for your kids to go to college. Once you've gotten all those things, then okay, go ahead and start paying off, a mortgage at 3%.
Because of the low interest rates.
So low.
Yeah.
Yes, you've got a 30-year term on a 3% loan. You can't get money like that anywhere else.
That's a cheap money.
Yeah, and so, but now that your rates are close to 8%, now you have to start looking at it going, okay, if I don't feel confident that I can earn that kind of a return long-term safely, let's just start paying that thing off, getting it paid off. Because you're building up equity in your home as you pay that loan down.
Yeah.
So you'll get that money back at whatever point in time you sell the house. So it's your money, and now you're not having to pay interest on it as you pay it down.
Okay.
So so I think the question in the conversation is more important now than it was a couple of years ago, because it does come into play and is a helps people with their finances. But whether it was then, whether it's now, if you're going to pay extra, it's going to be because you've had the discipline to set money aside, not spend it on other things, and use it to apply that mortgage.
Awesome. Let's talk of different types of loans out there. I know generally, to give people an understanding of the different types of loan and what are the differences in all of these loans.
All right, so the two biggest loans that you hear compared are the conventional loan and the FHA loan. Those are the main two. Someone who's a veteran may be able to get a VA loan.
Okay.
If you're buying out in the country, you may be able to get a USDA loan.
Okay.
Some of the benefits with VA and USDA is they offer 100% financing, so you don't have to put any money down.
Okay.
A first-time home buyer might qualify for a THDA loan, which allows a secondary type loan to help with the down payment.
So I've seen a lot of people ask me, is there a first-time home buyer loan? Is there anything like that?
Yeah, that's what a good example of a THDA loan would be. Most of the studies that get done determine that probably 60% of the people say that the biggest barrier of entry to buying their first home is down payment.
Down payment.
Not enough money.
Okay.
And so that's what most first-time buyer type loans are geared to help. And THDA, as an example, offers a loan that you can take out, and it's actually right now they offer it at the same terms as your first mortgage that you can use to help pay your down payment and your closing costs.
So it's not a free money that they are giving you as down payment.
As I mentioned earlier, there's no magic pill that for free.
That is what a lot of people think when they say first-time home buyer loan, as if government is giving them one free money to buy a house.
There have been programs in the past where you can get grants. There's nothing really being offered right now from the government other than programs like USDA, THDA, those type of loans. And so, there's no, like I said, there's no magic out there that just lets money all of a sudden appear to you.
No magic out there. How I wish.
Yeah, wouldn't that be great? But anyway, back to the comparison of the two loans, which are conventional and FHA. What would predominantly credit score will impact that more than anything else. To make it very simple, FHA will look at a borrower, and it's more of a one-size-fits-all, so that the rate being offered, the mortgage insurance payment that you make when you don't put 20% down, those are going to be pretty much the same regardless of where your credit score is. Your credit just has to be good enough to qualify. Whereas on the
so let's break down a little bit. So for the FHA, it's like one size fits all. And what that means is that regardless of your credit score, you are going to get the same interest rate.
It's not totally regardless, but it has much less significance.
Less significant impact than the conventional loan. Okay.
Now the rate could be impacted a little bit with a really low score, but the mortgage insurance that you pay with FHA is the same regardless.
So the mortgage insurance that you pay is the same on FHA regardless
of your score.
Of your credit score.
Correct.
Interesting.
Whereas on a conventional loan, the lower your score, the higher your interest rate's going to be, the more expensive your mortgage insurance.
What is the mortgage insurance?
All right, great question. So when you put less than 20% down, you're required to have mortgage insurance. It's insurance that technically covers the lender against default. Yeah.
So the buyer is paying the lender.
The buyer's paying for the insurance.
Oh my goodness.
But the lender's also letting the buyer borrow up to 97% to buy the home.
So that is the risk on them.
That's the risk the lender is taking, and so they're basically saying, okay, we're taking this chance, this risk to loan you 97% of the value of this home, but we want this insurance in place in case you don't pay and you default, and we have to come in and take the house back. This insurance is going to help us recover some of our losses.
Interesting.
That's from a lender's perspective. Yeah. So that's kind of what mortgage insurance is and how it works. And on a conventional loan, the payment that you make for that mortgage insurance is tied directly to your credit score. Whereas with FHA, it's like I said, it's a one-size-fits-all.
So for the conventional loan, the mortgage insurance is tied to your credit score.
Yes,
Okay.
yes. And it's also tied to the loan to value.
Okay.
But the credit score plays a significant role, and that's why if someone's wanting to put minimal down, 3 to 5%, one of the first things we're going to do is look at their credit score, and then depending on what their score is, if they've got a really high score, it's probably going to be cheaper to go to the conventional one. If it's a lower score, FHA is going to be the route to go. Now, one other comparison between those two with mortgage insurance is that conventional, you actually can get out of the mortgage insurance at some point down the road once you've reached a certain loan to value. You've paid enough down on the principal that the mortgage insurance can go away. FHA, once you sign up for it, as long as you have that FHA loan, you'll pay that mortgage insurance.
So on your mortgage statement, when you see that mortgage insurance, if it is an FHA loan, that mortgage insurance will be on that loan for the lifetime of that loan, except you refinance. Is that correct?
Yeah, if you refinance it to say to a conventional
To a conventional loan.
less than 80%, then you would have no mortgage insurance.
So I see a lot of people ask me, DJ, tell me, should I take conventional loan or should I take FHA loan? I said, well, I'm not a lender. Here is the professional lender. So tell us, what should people take, FHA or conventional loan?
So the number one question goes back to what we said a second ago, is credit score.
Credit
So
score.
see that. Secondly, how much you're putting down.
Yeah.
Because if you want to put down minimal amount, FHA only requires a 3.5% down payment. First-time buyer can put 3% down on a conventional loan. After owning a home, 5% is the minimum you can get in for with a conventional loan. So if you're at that stage and you only have 3.5%, you're going to go FHA because it's less amount out of pocket. But so you're going to look at, and also on the conventional loan, the more you put down, the lesser the mortgage insurance cost can be. It's tied to mortgage, it's tied to credit score, but it's also on a conventional loan tied to how much what the loan to value is. So if someone has 10% to put down and they got great credit, 9 times out of 10, that's going to be conventional loan.
So at the end of the day, people just have to make that choice for themselves. It's not necessarily one is better than the other. It depends on individuals' conditions and
what I'll
situations.
do is I'll give them the options for both. And show them here's what it looks like if you go to conventional, here's what it looks like FHA. Let them decide.
Let them decide. Awesome.
And I may nudge them in the way that I know but I'll let them decide.
Yeah, that's one thing I really like about you. Give people an objective analysis. Well, these are the pros and cons of this. These are the pros and cons of this. Make the choice.